supposed to be like a super fast sports car, and all of a sudden it's this weird looking SUV.
They saw this market where you go, that dad, he wants that power. He wants that power.
And he wants his 3-year-old in the back.
I want to go at least 150 with that 3-year-old in the back.
This podcast contains the arguably witty banter of two friends, Skippy and Doogles, that like to debate about investing. The content is intended to be entertaining and for informational purposes only, not investment advice. You should do your own research and consult a financial professional before using any of the information in this podcast, and especially before investing.
Skippy and Doogles are back, baby. I know you missed us because we've been gone for a week, but we back. We back with y'all. Stop, rate, and review the podcast. skippydoogles@gmail.com. That is how we get listener mail, and follow us on all the platforms. We got 3 topics for y'all today. The first one, there's a blog post called Ferrari Status. This is about how you go from trying to get all the markets to thinking about how do we become more disciplined. Second, why English-speaking people are unhappy. And the third, passive investing and how it's starting to dominate versus active investing and what that might mean. Those are 3 topics for you today. Going to kick it off with Ferraris. This is what you drive, Skippy. Because you all fancy like it.
Yeah, something like that, Doogles.
No, you're one of those, you buy the Toyota Sienna, but then you take the emblem off the Ferrari and you put that on the front. Is that you? Is that the kind of person you are?
No, my cars do not attribute to my status. Let's put it that way.
He's more about the steak versus the sizzle. That's what I like about Skippy. So this piece by Ted Lamade in the Collab Fund. I thought this was really interesting, especially given the times where you are right now. In the highest level, what this is stating is that when you try and go after everything, which is what's happening in the markets right now, we'll give some examples of that. When you try and go after everything, you start to end up forcing things like growth, start to force feed what's happening, and you lose the discipline, you lose potentially long-term profitability, you just lose your ability to execute over the long term. The reason it's called Ferrari status is because the stance that Ferrari has taken, which I'll state right now. Ferrari will always deliver one fewer car than the market demands. What does that mean to you?
I haven't done a deep dive on this article, so actually this is more fun. It means their management team is kind of lost because it's a great talking, like, I love this. I'm consistently telling companies maybe you shouldn't flood the market because it means is your profit margins erode and eventually disappear. The problem is competitors will, especially if you're a highly profitable business. We're going to talk about the performance of Ferrari's stock price, and there's a reason that it's performed well. But that implies that it's knowable to predict what demand will be, say, 12 months from now or 24 months from now, always.
Well, no. Okay. All right. Okay. No, it doesn't necessarily mean that. I get that take, but that's not really what it means.
You're going to make a bunch of cars and sit them in the warehouse because your demand collapses, and so you're going to be like, we just don't sell these? Are you going to send them? Are you going to crush them up, send them to the dump? That's the only way you guarantee that this actually happens.
Well, this is saying one fewer, so you don't have that inventory sitting around. And by the way, the one fewer, of course, is a symbolic thing. It's like the 10x engineer. It's symbolic. It's not math. I'll give some stats, and then we'll continue this debate. From 2020 to 2024, Ferrari sold fewer than 60,000 cars, but for an average price of over $450,000. Since 2020, Toyota has sold more than 52 million cars at an average price of $32,000. GM has sold close to 30 million at an average price of $51,000. Going back to that margin point that you had, Ferrari's looking at margins that are about 23%, and Toyota and GM less than 6%.
Yeah.
60,000 versus tens of millions. So this is, when they say one fewer, I mean, they're really talking about 30 million fewer. The point here is not we're crushing up cars and sending them to the junkyard. It's saying we are running a luxury brand.
Yeah, whatever, Doogles. And the luxury brands don't deal with supply and demand challenges. They don't deal with collapsing consumer economic conditions. Like, come on now. It's too idealistic for me. I understand the point.
But what's the point? If you understand it, you explain what the point is to me.
The point is Toyota's going to sell 50 million cars and we're going to sell 50,000, right? Orders of magnitude different. Mm-hmm. But to say we have, and this is true, I remember some stats, I don't believe they're in this article, about how Ferrari almost sells itself as this elite status institution. And I think like half of Ferrari buyers have bought a Ferrari previously, right? It's more about like, I'm in this club. Like, I paid $500,000 to be in this club, and I want to continue to be in this club, which is brilliant. Nice work on their end. But it's not truly, we have a wait list for X. You know, we have a wait list for 100K and we're only making 99,909. I know you're going to be fired up that I'm being that literal about it, but it's not.
Oh my gosh, this guy. Let me convert this into something else, going off the blog for a moment, because the broad point, I get your literal take here, but the broad point is when you start going after growth at all costs, you can become blind to other factors. And so it's really just about how do you think about discipline and discipline growth versus that, as Bill Gurley states in here, he compares this to foie gras and saying when you start force feeding ducks, like you're taking something and saying we have to find, like you have to grow this TAM by X% in order to justify us getting an up round in our next funding. And so therefore we have to grow, and you're going after bad customers. Outside of this, I think about...
Go ahead. No, like the way I say this with my clients is you have to be willing to fire some clients if you want top tier profitability. Because if you take all the riffraff that shows up, and that's what I'm saying with Ferrari as well, like you can't sell, and this is where I like their phrasing actually. You can't sell to hit a target, right? You can't be like, we need to do X amount of revenue in 2026, which means we have to sell this many cars, regardless of what the market demands. I like their discipline.
So you're sold.
Kinda.
But that is the point. Because Ferrari could likely come out and say, if they sold fewer than 60,000 cars in this 5-year period, they probably could have sold 500,000 cars. Maybe not 30 million, but they probably could have sold 500,000 cars, making up that number.
But if they sell 500,000, then in the next 5-year period, they can sell like 0.
Oh, no. Maybe they can still grow. My broader point is actually they could do that by, so that's 4 times as many cars. You take your profit margin, they'd have to decrease costs in order to do that, decrease the price in order to do that.
Okay.
So their profit margins start to go down. So that they're running a different business, and they're choosing to run a more disciplined, high margin business. And that, I think, is where discipline comes from. You can do it in the broader sense, too. I think about ignore the Southwest of today necessarily, but in studying how Southwest grew over long periods of time, there are other companies I could mention that did this too. They thought about growth as we're going to grow by like 20% a year. They would turn down gates. They would say, we actually don't want gates at that airport because that would erode our general business model. It's the firing customers or not hiring the customers in the first place. And I think that's the take here. And what you see more in the markets is people are grabbing and saying, we have to go there. Vanguard is saying, we have to go into the private markets. That's what's happening right now. Like, whether or not that ends up being a good or bad idea, time will tell. But it's
a bad idea. Shut up. Sorry. Like, don't throw that one at me. That's a bad idea. Sorry.
But that's kind of that's the world in which we're living, in which people, companies, and probably people too, are looking at their current business model and saying, we kind of have to break this in order to grow in the way that the market is saying that we need to grow, which is not disciplined. You can make it sound disciplined in a deck. You can make anything sound disciplined in a deck.
So is that your larger point? Because I am 100% on board with that. Having discipline about your niche is the only way you get strong profitability. When you try and be everything to everyone, you take, to my point earlier, you have to take a bunch of riffraff in the door that's more expensive to service, that is harder to please, and your profit margins erode like clockwork.
Yeah. Ferrari is emblematic of it. It's not the example that everyone should go after, but it's kind of the extreme of what can sit on one side of that spectrum. And I think that's why it's good to look at that, because extremes can be helpful. When it comes to principles, extremes can be really helpful.
This cracks me up because I make a parallel to Porsche, and I'm not a car guy. I know they're not exactly the same, right? But you remember 20 years ago when those Porsche SUVs started coming out?
Oh, yeah, the
biggest
Cayennes.
Contradiction on earth. It was, like a Porsche supposed to be like a super fast sports car, and all of a sudden it's this weird looking SUV.
Because they saw this market where you go, man, that dad, he wants that power. You know what I mean? He wants that power.
And he wants his 3-year-old in the back.
Yeah, but he also, I want to go at least 150 with a 3-year-old in the back. That's the truth. No, I hear you. I hear you. One thing I liked in here also that came in the Bill Gurley section is he says, it feels like we didn't learn anything from the days of 0% interest rates. And I think it's a really interesting take right now. Because during 0% interest rates, you have this land grab. Money is so cheap. You can go after whatever you want, and it's less expensive to fail. We're not there right now, but the same mentality seems to persist. And so you think you get those interest rates up and hopefully that reins things down. But we've talked about this in the consumer segment. Consumers are still buying everything. No matter what, it still seems like people are buying stuff. Businesses still going after that bigger TAM. So I think that point, which I hadn't thought about it in that way, I think that point is pretty awesome that he's making there.
It's tough in organizations of tens of thousands of people to be nimble. Everyone knows that, right? And I think...
Unless you're Mark Zuckerberg.
Yeah, true. I think if the zero interest rate era led you to growth at all costs, when the market evolves and maybe you don't need growth at all, maybe growth at all costs is not smart, it's really tough to change course. That's why I think it's institutional momentum. That's the biggest challenge there.
And it's hard. The amount of credibility that you likely have to have with your employees, with your board, with your fellow execs to be able to say something like, which I think in some cases, this is the right move, to go, for the next 3 years, we're going to be flat to down on growth. Because what I envision taking place over the next few years is that the market will realize that it is outpacing itself, it will fall, and we will have the cash on the other side to then grow. That's the kind of thing that is really, really difficult. It's what you've brought up with Seth Klarman before, when he's like, I'm actually just going to return your cash because like now's not the time for me to be deploying it.
The flip side of this is it's just not practical. When I was a young, naive banker and the market was frothy and we were coming off, 2008 was not too far in the rearview mirror.
Yep.
I was known to make the argument that maybe we should tap the brakes a little and make sure that we can roll through future cycles. The rest of my org said we can, and then our performance will be judged in the way everyone else's performance will be judged, and we won't be here. The crash is not even something you can consider. You have to bring new revenue in the door. That's one of the challenges with banking, but it's a lot of things. Yeah. And that's where I'd argue that founder-led, mostly privately owned organizations have this huge advantage because you can say, I can make a few less million or a few less 100 million right now, but 30 years from now, that's going to be a huge advantage. You don't always have that.
I know that most people believe what you just stated. And I think that what you just stated is also mostly true for most companies, but not for all.
No, it's not entirely true. No.
If you are a solidly run business who has been disciplined prior operationally and has the credibility with the key stakeholders, then I think it's easier. And I've just seen this in businesses I've studied. It's easier for you to be like, yeah, we're going to get hit, but we'll still be here.
Name a few of those businesses. Berkshire Hathaway. That's your first one. Yeah. Who else?
Progressive Insurance, Stryker Corporation, Southwest. No, they did it.
No, old Southwest, not today's Southwest.
I'm talking over decade. Like this, I'm talking the companies that have been successful over multiple decades. I have seen them do this during periods in their life cycle.
Old Southwest when the dude Herb is still at the helm, correct?
It would have been after Herb, but he was probably still on the board. Yeah,
still on the board. Okay, so that falls into my idea. I think this is really rare.
It's very rare. You know what else is rare? Do you know what else is rare?
Profits.
Highly successful companies, also rare. That's what I'm saying. I'm talking like the creme, because the companies that I'm naming, if you looked at over given periods of time and decades, they are the most successful companies during that period of time. That's what I'm talking about. I'm picking the cream of the crop. But all I'm saying is that whether or not you go to that extreme, because maybe, as you were stating, maybe Ferrari status isn't really the extreme that any other company but Ferrari can go to. But I think that the principles here are helpful to bring in because I've seen too often the have to grow, we have to raise. Going back a few years ago, in 2020, 2021, we have to raise money at these valuations because everyone else is doing it. Then what happens a few years later? You're regretting. Well, no, people justify the raise because they're all at the time we were thinking you can't look at, no, screw that. When you've seen this movie enough before, you get a sense for like what it's going to look like. That's all I'm saying. All right, I'm getting too hyped up now.
Getting fired. You know the best thing I read this week? I mean, it's from the FT.
Ooh, Financial Times. Okay.
The article.
Is this another? Are you fishbowling? Are you fishbowling right now?
I'm fishbowling.
Okay.
Yeah.
Okay. All right.
Why are young adults in the English-speaking world so unhappy?
Okay. I didn't read this, so educate me.
Truly, my boy, John Byrne Murdoch. What a name. He has all these graphs because he's a visual data expert. And he says in the Anglosphere, is that the right term? I never really talked about the Anglosphere.
He used it, so it's a word at least.
there's a clear trend towards young people being unhappy that is very different from Western Europe. And the main countries he's talking about here are US, Canada, UK, Ireland, Australia, New Zealand.
All right.
All right. So the data is crystal clear. I'll let you guys look at the charts if you want, but the data is crystal clear. Young people in those 6 countries are not super happy right now. And there's a lot of reasons why that might be true. Where he ultimately goes is that it might tie to housing. But before we even talk about housing, I want to talk about the most startling graph in this, which is the percentage of people in the Anglosphere that think hard work pays off. If you're older, if you're greater than 50, older than 50, in this country, let's simplify and talk about America for now, you think hard work pays off. If you're 25, you are likely to not think that hard work pays off. And when you tie that to housing and the affordability of housing across those 6 countries, New Zealand is particularly bad with housing affordability. Canada is particularly bad with housing affordability. Ireland is particularly bad. The U.S. is getting particularly bad in certain communities. The hypothesis he paints here, he ties all those things together, and he says, it looks like if housing gets to the point where it's completely unaffordable for the younger generation, and housing has been told as a story that this is the American dream, or maybe this is the Anglo-Saxon dream, then people go, well, what's the point? Because that seems like an unattainable goal to me, to own my own house. I'm 23 years old today, and I went to the right college and I did all the right things, and it still seems like an unattainable dream. It seems like the American dream is taken away from you, and therefore there's this rebellion in consciousness that leads to some of the political things happening. To me, this all makes a ton of sense. And it's so funny to think about the unintended consequences of housing policy being like, I mean, to go to the easy example, I'm not sure that there's a direct line, but that there's like a socialist political movement because people are rebelling against this fact that my hard work doesn't matter and my American dream isn't even possible. Do you buy any of it?
I buy the theory, and I think you summarized that very well. I think that we have failed at teaching young people how to think.
Please explain.
The mentality that you described, the fact that there's the belief that hard work pays off by itself, the fact that that's like the baseline of thinking, like that's the question. At most, I would say this, like, yes, you have to work hard. It's a factor. It's an attribute. All else being equal, the person that works the hardest, it will pay off. Guess what? Most of the time, all else is not equal. So therefore, you have to figure out what else in addition to hard work works. And I don't think we've taught people how to think in that way. It's not particularly thoughtful. Sorry, let me be nicer. Because I understand where people are coming from. I get it. However, if you look at if we've talked about all this before too, but I think it is worth repeating this context. What happened in the Anglo, and I'll just say the more like the U.S., because that's what I know. The U.S. for people of a Caucasian background in the 1950s were basically given homes. Then you have this period where coming out of the 1970s, 1980s, when you had the high inflation, the high interest rates, right, all that, low home prices, then getting homes and holding those for long periods of time built a lot of wealth. So you have this period from like the 1950s for 50 years where a home was a great way to build wealth. Guess what? We're not there. So like to me, it doesn't take a lot to then say, okay, so home is no longer the e-ticket. Doesn't mean it never will be again, but like obviously today is not the ticket. So buying a house should not be my barometer. And I think we need to teach people how to think more dynamically about that versus saying the last generation did it, therefore it should also be my ticket.
It's a fair point, but the last generation is as guilty about this as probably more guilty.
Yeah.
Because do you know how many parents are telling their kids right now, I bought my house for $50K and now it's worth $1 million and it's the best investment I've ever made. And they're doing that calculus wrong because they're not factoring in maintenance and inflation and everything else. So that's a whole other thing. They would have been better off investing in the S&P 500. Yep. But the cultural talking point is still that home ownership is the dream. And you and I sometimes have brains that work like calculators. I would never buy it. If I was 23 right now and I looked at all the charts that say buying a home is the most unaffordable it's ever been and renting is a significantly better deal, you have to get comfortable with renting. That still does not mean that there's not a correlation of events here that makes people unhappy, which goes back to the original part of the article, because happiness might have been prescribed or described to them as you go to the right college, you get a nice home, you get your dog, and then 2 kids down the road. And it's different. The equation has changed.
Exactly. And that is probably the simplest way when I was talking about teaching folks how to think, the soft skills, is that the checklist doesn't exist for certain populations in the same way that it did for those same populations in the past, where you do this, then you do that, and then you get this formulaic. No, you just have to think about it. I disagree with the fact that the American dream is dead. Like, I fully disagree with that fact. I think that the most powerful thing about America when it comes to the American dream is the fact that it's possible. Like, it is possible to go from 0 to hero or 0 to like doing fine. Like, that's possible here. There's so many places where it's not possible. I'm not going to discount the fact that to certain folks it feels impossible at times, but I just want to look at the definition of impossible, because there are places where literally you can't do it. If you are born into like this caste, you're there for life.
Yes.
That is not where America is. But here, to go back to the all else, if all else is equal, but it's not, fact, is you just have to say, what is the system today? How do I work that system? There are serious barriers and systematic challenges to a large group of people. And right now, to young people, like you're saying, like housing is unaffordable. A lot of things are going to become more unaffordable. And that seriously sucks. But the dream isn't dead. I don't want us to throw out the whole dream because mechanics are different today.
All I can say in response to that is, if I was a politician, and I have no desire to be, my primary policy would probably be to build a ton of housing.
Yeah.
Everywhere, all the time. Yeah. Permitting would be streamlined. And I think in this case, if you did that, there are no longer unintended consequences. They might be intended consequences. The intended consequences of that would be a happier youth. The ramifications
How do you give hope?
Of housing are great.
How do you give hope?
I think you give hope with affordable housing.
Well, I'm saying that the question that you're answering is, how do you give hope? Like, the strategy is giving hope for the future.
Yes.
It's where, independent of all the like specific policy things or whatever of administration, the part of the Make America Great Again, like the piece that like impacts me is that we're talking about the past and not hope for the future. Like, that I think is not helpful especially for folks that like if you go back to the conversation we were just having, if you want to make it great again, then you look into the past to say, okay, what worked then? What can work today? As opposed to, we could be in a new paradigm. So how do you succeed in the future? Like, what does great America look like? And it's a mentality. Now, that was a mentality that has won 2 presidential campaigns. So I'm saying, from like a marketing standpoint, maybe that's the way to go. I'm not saying that that's wrong from a marketing standpoint, but I think mentally it's not helpful for us as a country.
Yeah, I think there's some truth to that.
Yeah. Whew. I do like to get off of my soapbox here, the argument that you summarized before, though, around what could be doing to the happiness, I think it's a really interesting one. Correlation causation is always hard to know in these facts, but it like logically makes sense.
I bought it hook, line, and sinker, or whatever the phrase is. I mean, like, there's something going on there.
There's something going on there. Oh my goodness. All right, so should we transition to our last fishbowl topic?
Let's do it. Nerddom, Here we come.
Nerddom, here we come. We're bringing in research papers. People, I know you love when we bring in those research papers, so we're doing this for you. Not even interesting to us. We're just doing it for you. There is this paper called Passive Aggressive: The Risks of Passive Investing Dominance. Chris Brightman, research affiliates, and Campbell R. Harvey from Duke University are the writers on this paper. And I think anyone that's probably listened to this podcast or has been following the markets understands that passive investing, which is when you're investing in an index source or something that is indexed to specific stocks that you don't have to think about what are the pricing dynamics, what are fundamentals. It just automatically rebalances, et cetera. That has taken over the market. Specifically, in December of 2020, passive overtook active. And the chart is dramatic. Take a look at the Substack on Monday, Skippy Doogles at Substack.com, and you can see the chart that's in this paper. What it shows is that if you go back to 1993 is where this chart starts. If you go back that far, that's when is that when SPY? I think SPY first came out, 1993-ish. So that's probably when that starts. If you go from there, you basically have passive that is effectively 0%. About 15 years before this point is when John Bogle, first launched an index fund, but it took a bit for folks to start to really like him and catch on. This is when it became mainstream. You go from 0% then to over 50% of the market in December 2024. And now passive continues to rise. It's now 53%. Active is 47%. So that's the facts of when we're saying passive is taken over active. That's what that looks like.
Yeah, and in the past 10 years, 8 of the 10 years have had outflows for active investor strategies, and the inflows head directly to the passive investing strategies, right? I mean, this is consistent, almost appears like it's unavoidable now. The question is, how far can it go before it has to normalize and swing back?
That's exactly right. It's kind of saying in this paper that there's a time where passive was the way, or that time could still be now. But if you go back a few decades, passive is the way that the people rise with the markets and the markets rise together. And there could be some point where passive could be the reason why everything crashes together. Here are a couple facts from this. And there are a few reasons for it. I'll go through the reasons.
I'm not sure that it could.
Now you're predicting.
Here's
yes.
Like, I hate
That's
forecasts, but if this trend continues to an extreme, it's guaranteed. I don't know that
guaranteed.
100%. If 100% of it investing happens passively, then people are blindly buying stuff with no regard for value. So,
and that's what's happening now is what they're saying. This is exactly right. So passive funds allocate more to stocks that are already up and less to those that are down. That's just by their very nature. And specifically when you're looking at market weight or market cap weighted indices. Then you have a dilution of diversification that occurs. So stocks with high passive ownership display rising betas. That's correlation with the market, to think about that simply. And actively held stocks show declining market responsiveness. So if you look at ETFs that are out there, right, they trade in baskets. An ETF is a basket of stocks. And if that's passive, then you have unrelated companies that are moving relatedly because they're in the same basket. This creates systemic fragility, which is why you were just saying what you were talking about. There's passive selling that happens. There's passive buying that happens. Then there's the price discovery erosion. I think this one is interesting. It goes to your fundamentals point, because active managers back in the DizWiz, they could be the ones that are setting prices because they're going out. They're looking at fundamentals. They're doing individual stock picking. All the information that's out there is reflected in, to go to efficiency. But with passive flows, you end up with trend following. The price discovery starts to go away. It doesn't matter what the price Datadog is. If Datadog's in the S&P 500, those indices are buying Datadog.
Mm-hmm.
So that's the kind of thing that ends up happening. And so what this paper is looking at is it's asking the question that you raised as a statement of, is there a point / what is the point where passive ends up taking down the markets? I think it's such an interesting and important concept, especially because there's just so many passive indices out there. I knew this intellectually, but over the past week, for unrelated reasons, started looking more at the ETFs that exist out in the market, and they're like, so many that are just the same. iShares has its S&P 500. Then you have Vanguard with the S&P 500. Then you have, we're actually just doing the S&P 400. Oh, no, we're doing the S&P 50. You go, okay, cool. But if you're taking the top market cap weighted ones, you're effectively the same. You're the same indice. And so then you have multiple of these, but they're just more ways for people to get in.
Yes, but there's still some niches in the ETF market that are missing. And man, I have some ideas for you, Doogles. That's an off-pod conversation. Yeah.
Okay. Like that. I like that a lot. So that's the point of this paper. For the papers we usually go over, this is one of the shorter ones. The content of the paper itself is like 9 pages. So if y'all want to dip into nerddom but not be too nerdy, this is the paper for you.
I have something nice to say. Campbell Harvey, he's one of my favorite things about Duke University. Great guy. Pretty much the only. There's a few more things, like a few more grads that I like, but that's it. Everything else, no.
You love you some Campbell? Cool. You love you some Campbell Harvey?
He's a good guy. Yeah, I like him.
Cool.
Let's wrap with this. The Man Group came out with a survey, a chart this week. It'll be on the Substack. That shows the percentage of the MSCI World stocks trading above 10 times enterprise value to sales. I'll do the mini rant that I always do. If you're trading at 10 times sales, that means if for 10 straight years, assuming sales stay fairly similar to where they are today, 10 straight years, if you take all the money, assume you have no operating costs, no cost of any kind, and gave that back to your shareholders, they would just break even. That's all that would happen. We obviously know that's not how business works. A lot of times the revenues go down. Certainly revenues go all over the place. And there are a crazy amount of operating costs to do this. So even the world's best companies may have high gross margins above 50%. In that case, it would take 20 years to pay back your investors. This is a very good gauge of frothiness in the market. The last time it was this high, at least this chart only goes back like 30 years, was never. In the dot-com bubble, about 22%, 21% of stocks were trading at this multiple, and then it very quickly collapsed down to about 3% of stocks. Currently, we are in the 22% range. And the amazing thing is we got similar to that back in 2021 before there was a massive pullback. And then we've just decided that we want to be back in 2021 land again, Doogles. Yep. It's interesting, but honestly, 2022, I felt like we could stop talking about the bubbliness of the U.S. market. We're right back we started. I mean,
we're above. We're above.
I'll say to our friends who listen to the show, like, good for you. I hope you made some money. We don't give advice, but I hope you have somewhat of a conservative strategy in your back pocket because you might need it. You might not. We might go up another 50% before anyone even cares. It's like you said earlier. People are spending money. People are buying investments. It all seems great. It just is back to a place where it hasn't ended well in the past and it won't end well in the future. We just don't know what the timing of that will be.
That's a great upbeat way to end the show.
You can always count on me for upbeat. I'm going to go buy a Ferrari right now. So
yes, there you go. YOLO.
All right, guys. Thanks for hanging out. We'll see you next week. In August, we're not sure the exact date, but in August, we're going to do something new on the show. We are going to spend a lot of time breaking down a specific company, and we're excited for you to hear that. So make sure you check back in for that.
Stay tuned. Thank you.